Today we're going to talk about how to choose your entity type. The entity type of your business is an important decision, and it should be one of the first things you consider when you're a new business owner. Although there are only a few options and it's pretty easy to eliminate a few of them just based on the number of people involved in owning the business, there's a lot of noise around this topic. Everyone thinks that their viewpoint is the only one that can be accurate, so that's what everyone else has to do too. People also think that they understand how taxes work and that their solution is the one to solve your problem. But your entity type is a very personal decision based on your individual risk tolerance and your household tax situation. Entities are created at the state level. Usually the home state of the business owner is the state of choice. There is a common misconception about setting up a business in Delaware being tax advantageous. But that's just the result of a really good marketing campaign by the state of Delaware. And while it's true that Delaware doesn't have a sales tax, we all know that aunt and uncle or neighbor that takes full advantage of that by driving out of state monthly for their liquor. Delaware does have a state income tax. And there's no avoiding the state income tax if you live in Delaware. There's also no avoiding the state tax in the state that you live and where the business operates. Most states assess tax based on where income is earned and where the business is operating, not where the business is registered. If you want to avoid state income tax, move to Texas, Florida, Alaska, South Dakota, Wyoming, Washington, or Nevada, and operate in one of those states. Okay, enough about state income tax. Back to which entity setup is right for you. So as soon as you start collecting money, if you've done nothing else, by default, you're a sole proprietor. That's usually the starting point for most businesses. Now, if there's more than one of you, let's say two best friends, and you're in business together, one is the marketing and sales guy and the other is the engineer, well, you're a partnership. If two or more people enter a business together and set up no legal entity or anything else, they're still considered a partnership, which means that every year you are required to file a Form 1065 partnership tax return. And that's important to know because non-filing of a corporate tax return, which a partnership is considered, is a $3,000 per tax year penalty. If you're a partnership, you should register with your state either as a multi-member LLC or as a general partnership. Get the business name registered, get current with all requirements by the state to operate, sign up for sales tax if needed. If you're going to be paying employees right off the bat, get yourself the correct withholding tax account number so that the payroll company has everything they need to start paying payroll on your behalf. You'll also need to register with the IRS to obtain an EIN. You'll need this EIN when you file Form 1065 with the IRS by March 15th every year. If you're the sole owner of a business and are operating a sole proprietorship and want to give yourself a little bit more protection personally, in case anything goes wrong in the business, you can register with your state as a limited liability company or an LLC. An LLC is not required. It's purely a personal decision based on what you're selling, what type of business you're involved with, and whether or not you have any personal assets that you'd like to protect. If you're teaching a glassblowing class to high school students, there is a high likelihood that something might go wrong at some point. And even if you have them sign waivers, there's a chance a parent might sue you. Do you want to deal with that? Is that ideal? Of course not. But the most important part of every plan is planning on your plan not going according to plan. So you have to consider that this actually might happen. And if it does happen, do you want your personal assets to be exposed to someone suing you in addition to your business assets? Your car, your house, all the stuff you work so hard for? Liability protection is the reason to set up an LLC. There are misconceptions around LLCs that they unlock some sort of magical tax savings, but that's not true. A single member LLC and sole proprietorship are taxed exactly the same way. Both are required to claim all business income on Schedule C, and both are allowed to deduct expenses related to generating that income. The decision to stay a sole proprietorship or become an LLC is only for liability protection, to separate your personal and business assets. If you decide to opt for that LLC protection, there's something important to remember, and that is to maintain separation from your personal and business assets. Don't treat your business bank account as if it's your personal bank account. Only business transactions should be running through a business account. If your business and personal funds are not separated, one could argue that you're not operating properly as an LLC, and someone who wants to sue you might be able to come after your personal assets. We already talked about sole props, which is where most businesses start. You can level up your sole prop by creating an LLC to give your personal assets some protection. If you start off with 2 or more people and don't create an LLC, that's automatically a partnership. But there's an option for a multi-member LLC as well, to give the other owners personal assets protection. If you're a multi-member LLC, you'll use the same Form 1065 that a general partnership uses to file the business tax return. No tax is owed with this filing. All income from sole props, single-member LLCs, and partnerships are taxed personally. A C corporation is the last option for an entity and is the only entity setup that pays income tax on business profits at the business level. If your entity is set up as a C corporation, as long as the bank accounts only pay for business-related items and personal and business assets are separated, you have the ultimate protection against something happening to your personal assets. As an owner of a C corporation, you can only lose the money that you put into the business. However, with that protection comes a business tax that must be paid at the business level on business profits. A C corporation is the only entity that pays a business income tax to the IRS. All other entities pass the profits from the business onto the owner, and the owner pays tax personally. Since the business pays tax on its profits, and business owners are taxed on those profits again when they're distributed, this is where double taxation comes in. The only way for owners to get money out of their C corporation is through a W-2 payroll or through dividends, which are both taxable on the owner's individual income tax return. But that's it. Sole prop, single member LLC, a partnership or multi-member LLC, and corporation. Those are the only entity selections available in the United States if you're a for-profit business. Now, you might have noticed that something's missing. What about S corporations? Well, an S corporation actually isn't an entity. It's a tax election made at the IRS level. So once you form an LLC or corporation, you have the option to elect to have an entity taxed as an S corporation. At a certain income level, there are definite tax savings. But depending on your tolerance for administrative work and additional work related to owning an entity that is treated as an S corporation, it might not be worth the amount that you can save in taxes. Be on the lookout for state S corporation elections as well. Form 2553 is filed with the IRS to request to be treated as an S corporation, but some states don't honor Form 2553 to change your tax status at the state level. So make sure you understand whether or not your state has its own election or whether they'll accept the IRS election. This is why it's good to have a relationship with an attorney nearby. We've mentioned it before, but your entity is not something that you should set up and just forget. This is something that you need to constantly be evaluating based on the projections for the business and the trajectory for the future. For example, if the goal is to go public at some point, you probably want to set up a C corporation. Now that might not be how you started. When you started, you were a sole proprietorship, and that was probably fine, but 5 years after your first sale, a lot's changed, and you found a niche and realized that you want to take on investors and really scale the business. Well, an S corporation limits you to only having 100 shareholders, and a partnership is way too messy once more than a few people get involved. So a C corp would be the best route for you. But if you started as a partnership and realized after a few years that you and your partner are better off splitting up and working on your own aspects of the business individually, you might not want to immediately become a single member LLC depending on where your income is and what you expect it to be in the future. You might want to seriously consider electing to have your LLC taxed as an S corporation, as there could be significant tax savings in doing so. If you found this video helpful, we're real accountants and CPAs who work with hundreds of small business owners just like you every day. Check us out at engagecpas.com to see if we're a good fit for your business. We also have business courses available to help small business owners understand their business. They're for you to learn about your financials, your taxes, how to pick the right entity, tax myths, and everything else about your business. Learn at your own pace. Check those courses out on the Education tab on our website. You can also find us on Instagram at Engage CPAs.